Hello, everyone. Welcome and thank you for joining our webinar to discuss the future of tokenized funds. My name is David Knowlton, and I'm the head of product for Galaxy Asset Management. I'm thrilled to be moderating this conversation, and I think there's a lot of fascinating topics that can lead to some really engaging conversation. As I'm sure you're all aware, tokenization and RWAs have been a really popular topic here in 2025. So we're going to spend some time today unpacking what tokenization really means, how it's disrupting the capital markets and asset management industries, but more importantly, how tokenization may have an impact on all of you in the audience. So to help educate us on these topics, we're able to put together a really great panel of industry experts spanning different segments of the tokenization ecosystem. So with that, I'd love to introduce today's panelists. From NAV Fund Services, we have Adi Sharma. From Chainlink Labs, we have Colin Cunningham. And from Galaxy Digital, we have Thomas Cowan. But guys, maybe before getting into some of the topics, I think it'd be great if each of you can provide a little more background on your roles and maybe a brief overview of your firms.
Hi everyone. Welcome to the webinar. I am Aditya Sharma, Assistant Vice President, NAV Fund Services. NAV is a leading independent technology-driven fund administrator. We provide fund admin services to alternative investment managers across the globe. Currently, we provide services to more than 2,300 clients, and those asset managers are managing more than $350 billion that we administer. Our team support both traditional asset as well as digital asset funds. And under fund administration, there are two key functions that we perform: transfer agent and NAV calculation agent. We are registered with the SEC in the US and other regulators across the globe in appropriate capacity to perform our services, such as Cayman Islands, Ireland, Australia, Singapore, and many others. Very excited to be on the panel today and discuss how tokenized funds tie into all the functions that we do, and looking forward to sharing practical insights for any manager or any other listener today who's exploring tokenized structures.
Thomas, how about you now?
I'm Thomas Cowan. I lead tokenization here at Galaxy Digital. Galaxy is a crypto-focused investment bank. So we have a few different divisions here: sales and trading, investment banking, as well as infrastructure. And it really is kind of those same verticals that you would see at a traditional financial institution, except with a focus just on all things crypto. So that's Galaxy in a nutshell.
Thanks, Thomas. Colin?
Yeah, absolutely. Thank you for having me today. So I'm Colin Cunningham, lead tokenization over at Chainlink Labs. So for those of you that don't know Chainlink, been around about 7 or 8 years. We're effectively the largest and most decentralized Oracle network in crypto and in the blockchain space today. What that means is that we're sitting at the center of, we're securing about 27 or 28 trillion in transaction value on chain today, and we're integrated to over 3,000 endpoints. When I think about what Chainlink does specific to tokenization, our role is kind of to be the connective tissue that's connecting a lot of the traditional financial systems, a lot of the traditional asset managers and issuers that are coming on chain to tokenize real world assets, and then enabling them through the Chainlink platform to interconnect to all the different endpoints of where those assets can either be purchased or they can be used. And so what Chainlink's doing is really providing the underlying infrastructure and supporting a lot of the different assets, a lot of the different protocols, and all the different blockchains that are popping up left, right, and center throughout the blockchain space. So excited to be here and get into the details today. Thank you for having me.
Yeah, of course. Thanks, Colin. Thanks, guys. I think it would probably be great for the audience maybe to start with some foundational background on sort of the state of play in the tokenization space. There's been a lot of trends with asset managers and issuers bringing their financial products and other RWAs to the blockchain. So, maybe Thomas, maybe just give sort of a brief update to the audience, like what's been happening in the tokenization space this year? What are the trends? And what do we think is next in the next 12 to 18 months?
Yeah, happy to. I think when I think of the market, for starters, tokenization has definitely been a buzzword in previous crypto cycles. This time does feel like we do have momentum in a way that we haven't with in previous years, and that's really for three main trends: technology, regulation, and institutional adoption. So from a tech perspective, we finally have the smart contracts and the blockchains that have a level of redundancy and reliability that can either match or outperform traditional technologies. From a regulation perspective, we have clarity not only here in the US through the Genius Act and the forthcoming Clarity Act, but also overseas through through different regulations that have come into play. And then finally, we have a level of institutional adoption and interest in this space that is becoming disconnected from the cycle and the price of Bitcoin. And so we're really seeing more and more institutions looking at this as just a big shift that is kind of a long-term trajectory and transition that many of these large firms are making. So increasingly, the conversations that we're having is it's less of the technologies looking to upend the existing system, but really instead to upgrade the existing system. And that's kind of the mindset that we at Galaxy have when we think about helping firms go through this transition. In terms of the market over the past year or so, we've seen clear product market fit with stablecoins as a more efficient way to move dollars, an easier way to access dollars overseas in emerging economies, and also as a trading pair for crypto native currencies. So stablecoins have clearly found product market fit. The next and biggest trend we've seen over the past year or so has been tokenized money market funds. There have been a few leaders in the space that have announced and seen clear demand to get the risk-free rate on chain. But what we're most excited about is kind of what's next. And we see demand on chain for tokenized funds that are kind of farther out on the risk curve with a little bit of a higher yield, as well as different structured products. So we do see these three trends of technology, regulation, and institutional adoption coming together to really help these large firms begin to make this transition and kind of upgrade the back end of the financial system more broadly.
Yeah, that's great color, Thomas. Addy or Colin, I'm not sure from your perspective if there's any other sort of trends you've been seeing in the space to help kind of complement the insights Thomas was giving there. But curious your guys' thoughts on like what's really driving the adoption that we've been seeing this year in particular.
With this state of the market, I think the tokenized funds are not like a experiment or like a pilot project anymore. We have been administering tokenized funds for like more than 2 years now, completed audit cycles, tech cycles, heading into the third year now. And these asset managers are managing billions of dollars, which are tokenized. So I think it's actually being adopted, and institution validation has created momentum for all of these assets. I also want to touch on regulation here. So in addition to the US, we've recently had, information like industry leaders are reviewing amendments to the Cayman bills, also, Private Fund Act, Mutual Fund Act, how custody should be held, how, you should have, administration review. All of that changes are coming in, and it points towards the adoption of tokenized structures.
Interesting. Thanks, Addy. Now, you mentioned you're servicing a lot of funds or starting to service a lot of tokenized funds, but maybe Colin, curious to get your thoughts here, but like as an asset manager or another issuer, why should I want to tokenize my fund to even begin with, right? Like what are some of the benefits as an asset manager to bring my products on chain?
Now that stablecoins are a part of the game, not being able to offer a tokenized money market fund or something that yields a bit more than some of the existing stablecoins that are out there today is just an opportunity that asset managers can't miss. So whether it's the more recent news with Klarna or some of the stuff happening with Bridge, or just kind of the old stablecoins are the ones who continue to dominate the market, right? With Circle's USDC and Tether's USDT. When I think about kind of the inception of the blockchain and this way of moving payments at a global scale, when it was kind of first adopted or first thought about, I think we really haven't come and I mean this in a good way, we haven't come too far off of that, right? So we're in this world where we're thinking about stable coins. The banks are exploring tokenized deposits. And so now that we have this world where we've got cross-border transactions that are 24/7, 365, every single institution, corporation, or protocol is thinking about a stable coin or enabling people to build their own stable coins. As an asset manager, I think you're now in a position where if you're not offering some type of investment product that can exist on the blockchain that enables these different corporates and these different pockets of capital to access in a lot of ways, whatever kind of asset they want, which I think Thomas rightly alluded to, kind of moving out the curve into higher yielding things, especially or higher yielding investment opportunities, especially as interest rates come down. It's just an opportunity that your competitors are going to take. And so what I think a lot about in a lot of the conversations we're having at Chainlink, because of regulatory clarity and because of the speed at which major Web2 fintechs or payment service providers or corporates themselves are thinking about launching their own stable coins or just using and accessing stable coins, there's now a market tipping moment in my mind where people can see the amount of capital that's either tokenized or going to be tokenized in some form, whether that be a deposit or whether that be a stable coin. And so what's happening, at least for us at Chainlink's side, and a lot of the conversations we're having with the larger asset managers, financial institutions, is there is a speed to market consideration now, which is like, I don't want to be caught behind. I don't have time to hire up the engineers or build all of this myself, or build all of this ourselves. How do we do that in a way that's kind of quick to market and also secure? And that's creating, I think, great opportunities for a lot of the crypto native or folks that have been in the space for a couple of years. And so it's an exciting moment to see the speed at which I would say the issuers are trying to meet the amount of capital that they're predicting to come on chain, especially in 2026.
No, yeah, I think that's really interesting. And, a couple of times now we've hit on sort of the adoption of stable coins and now obviously all different types of funds and yield generating opportunities being brought onto the blockchain. But, I would gather that most, crypto native investors or allocators are actually using stable coins, right? So, Thomas, you alluded that, one of the adoption points to bringing funds on chains or stable coins more specifically is that they can be used for trading pairs.
Yeah, so we're really seeing this transition happen in real time, where increasingly, to Colin's point, the conversation is shifting from a year or so ago of, hey, why would you do this, to how, and what this really enables, and how we are able to leverage this technology and leverage stablecoins specifically to be able to get in and out, and transform the liquidity profiles and the different treasury management systems that in many cases haven't been upgraded in decades, right? And so really, to your point, stablecoins are really ground zero, and it's interesting to think back, because I know 5-6 years ago people thought that tokenization would bring liquidity, and so the first thing people tried to do was to tokenize illiquid assets to bring liquidity, and it turned out that actually the most product market fit and the most interest that we've seen from institutions today are the opposite. It's the world's most liquid assets, the US dollar and the treasury market, right? Those are the two things where we've seen the most product market fit. And as we see additional funds come online, they're building on that utility of using stablecoins to come in and out and the risk-free rate to make sure that any idle capital still is able to get that 3.5%, 4%, whatever it is, over time. And we're really excited to see what that means going forward and how you kind of put these puzzle pieces together to build a transformative financial product that we're just in the early stages of today.
So we're seeing a lot of adoption with, sounds like cash, short-term treasury, money markets being tokenized and put on chain for generating yield. I guess what is next, right? We mentioned going out that risk curve. What are the other types, or what's next from a fund tokenization perspective that on-chain allocators are looking for and that other asset managers of these asset types, classes should be thinking about? So maybe, Thomas, just to let you keep going on that thought.
Yeah, happy to. I mean, as I mentioned, people are moving out the risk curve, and increasingly the conversations that we're having are like, okay, what are the key benefits here, and where do those benefits best apply to what part of the different asset classes? And to me, when asked this question, I really think of 4 key benefits that this technology is uniquely positioned for. And so really what that comes down to is instant settlement, transparency, secondary market, and higher LTVs. And so what I mean by that is instant settlement, because simply the underlying can just settle instantly because it's on chain. Second, again, because it's on chain, you have full transparency into the underlying assets that make up a fund. Of course, that can be tailored depending on what the issuer is looking for in terms of the level of transparency that they want to have to the underlying investors. And then you can create that secondary market because you have the information and you have the value put together in a way that our current system is siloed. And then that last bucket of higher collateral management, what I mean by that is if you have full transparency, lenders are much more likely to give you a higher LTV against those assets than today, simply because you can see what the performance of the underlying assets are in a given fund. And so when you think of putting those four things together, we really help drive that conversation with the asset managers and the TradFi players that we talk to kick off that conversation and think, okay, what's next? Where do we see this asset class going? And in our case, a lot of it is structured products and higher yielding private credit products that today are still mostly, actually almost entirely off chain. But we think over the next 18 months to 2 years, we're really going to see that transition. And we're in the beginning of that S curve of adoption where pretty quickly people are going to begin to really jump here. And we want to make sure that people are prepared for that transition.
Okay, yeah, very interesting. Addy, similar to what Thomas was just talking about, you'd mentioned money market funds, but are there other asset classes that NAV is beginning to work on that are being brought on chain, or what kind of asset classes are managers and issuers coming to you guys to learn a little bit more about and how the blockchain can benefit them?
Yeah, thank you, David. I can definitely share a few details around that topic. So we we have seen, we started off with a gold fund when we did tokenization for the first time. It was gold custodied in a safe, and then the representation was tokenized for that private fund. We've seen fund managers engage with us for real estate. We've seen alternative investments being tokenized, other metals, and venture capital also. But to Thomas's point, only the biggest volume has been on the liquid money market side. I do agree that asset-backed securities are like something that could gain more attraction, more yield. So maybe like these asset-backed loans on gold, or maybe asset-backed loans on other kind of underlying. We also have recently done like a campaign to our existing clients where we sent out emails, just like basic education about tokenization, and we got like tremendous response from our clients. Me and a few of my colleagues did conversations with those clients who responded, and turns out that everyone is looking for potential advantages on their existing structures, on how they can tokenize and add more value for their investors, because eventually like investors are going to be the ones driving, and they would want you to have like a tokenized share class, or at least like some offering, so that they can utilize that advantages or additional advantages like transparency, ease of use, self-service, or maybe application in DeFi. So those kind of things have come up during our conversations. Many larger fund managers are also thinking about tokenizing at least one class of their private funds. So I would not point out any specific asset class for now, but I think asset-backed structured product could be a good fit.
Great. So yeah, I think that just speaks to the trend that we're seeing, more bespoke yield generating opportunities of where we're really seeing adoption in the early days here. But Addy, you'd mentioned one thing that I think, changing gears a bit, that's interesting when we're talking about DeFi. And Colin, I'd be curious to get your thoughts here, right? We're talking about tokenized funds, but it's more than just putting a fund on the blockchain, right? There's many blockchains. If I'm thinking about bringing my fund on chain, like, are all blockchains sort of the same, or what kind of considerations should I be thinking about? And I'm thinking about the ecosystem and what the right chain is for my product.
What I do think is important is I think the way ecosystems are emerging and where people are moving across the spectrum. I think that's where, if I were an issuer, I would be thinking about being as agnostic probably as I could. As I think there's the thing that I've always loved about DeFi, and I started my career in crypto like in primarily on the DeFi side, specifically from a real world asset perspective, is that I think you're going to continue to see a lot of the innovation occurring there, right? And one of the things that I think is most important is that the way some of the perps protocols, the way some of these borrow lend protocols are thinking about things, and a lot of the different vaults and a lot of the different kind of looping and investment strategies that are emerging, all of those opportunities I think are coming. They started on kind of a couple of chains at first, but the proliferation of these protocols, you think about things like Aave and how they just kind of move across the spectrum or across chains. It's kind of limitless. Now, from a Chainlink perspective, and from a product perspective, we think a ton about just giving the issuer optionality, right? And we do that through our product called CCIP, which is the cross-chain interoperability protocol. So that if you're an asset manager and you're issuing a token, you're able to move that token across over 70 blockchains through CCIP today. What I think that leads to is I don't think it's any different than what you see in traditional finance and on a global scale, right? Which is that as an issuer or as a manager, you're going to be engaging not only on the concept within these ecosystems of what does primary distribution look like, or what does the appetite for real world assets look like on a specific blockchain or in a specific ecosystem? What's the technical design and nature of that chain? But also, in addition to that, who are the different protocols, right, that are creating different opportunities for holders of the asset from a secondary market perspective. And so I guess from the Chainlink side of things, we think a ton about kind of two things. We think about first security and second scalability. I think the optionality that exists is actually typically expressed more by, quite honestly, groups like Galaxy Digital, right? And when you're thinking about tokenization as a investment bank, as Thomas framed it, right? The issuers, the investment banks, the groups that are actually out there representing the assets themselves, they're typically the ones that are exploring. And I'm actually curious to hear what Thomas thinks on this. Just how far out the curve do you go from kind of a not a risk perspective, but how I don't know, entrepreneurial do you want to be, right? With some of the ideas that are cropping up in DeFi versus some of the names of the world's largest asset managers that are coming on chain today. They may not be ready to go that far that fast. And so that's maybe the concept I would give you is I think at Chainlink, we see the whole spectrum of crypto native instruments being used in some wildly creative ways versus despite the maybe the speed to market or the appetite to move on chain. I think once you're in this on chain environment, traditional asset managers quickly understand how wild or how creative it can get. And I think there's different levels of comfort in these early days with what they're willing to expose the asset to.
Yeah, happy to jump in there. I completely agree. I think the future is definitely multi-chain, and when we work with clients and investors that the most sense for a specific product, it comes down to what they're looking for: speed, dependability, design, the developer base, the investor base, the liquidity. All of these things you need to take into account and make sure that you're kind of creating all these puzzle pieces to create a product that makes the most sense to Colin's point, for a given issuer's kind of risk return profile and what they're interested in doing. But I think what's important as we dig into the weeds and talk about the nature of the technology, just zooming out for a quick second, at the end of the day, I think we want technology, tokenization at the end of the day to really just be kind of like encryption is today for the internet, where we don't really think about it, but it is kind of the back end that just enables the entire back end of the internet of the way we think about it. And, fast forward 5-10 years, and tokenization and these blockchains really should fall to the back end, and people just should see these assets move faster, have better transparency, and be cheaper and more widely accessible, and not have to think about kind of the back end tech stack that's enabling it. And that's why we kind of work closely with NAV and Chainlink and others to be able to create that turnkey tech solution so that people can continue to focus on what they're best at, which is the financial assets themselves and the investor base themselves, and make the technologies just upgrade that whole system.
We're talking a lot about yield opportunity, but as we're branching out into other asset classes, are there advancements either on the blockchain or from a regulatory perspective that will enable other asset classes to be adopted as quickly? Or how are we thinking about the next 12 to 24 months in the sort of RWA and more fund tokenization space specifically?
I think the kind of next barrier that I find, frankly, is education, and is working with traditional financial partners to really think through what this technology means for them and kind of separate the conversations around crypto and tokenization. And to me, crypto is digitally native assets. When you think of Bitcoin, Ethereum, and other, other assets that don't exist anywhere but on chain, versus tokenization, which is just a representation of traditional financial assets on an upgraded backend database that just happens to work better, faster, cheaper, right? Like these conversations should shift to the type of focus of, oh, this is kind of just like, which cloud provider do you use as a business, right? It's on the back end, you don't think about it that much, but it is a key decision to enable the rest of the technological base you're going to build for your company. So I think we're still early, and education is definitely something that we've found is one of the key barriers that we're hoping will really change and transform the market and allow people to continue this transition on chain as people go farther out the risk curve.
And I hope like our session today and the continuous efforts that we are making at Galaxy, Chainlink, at NAV will educate these prospective explorers. And then, we are always there to provide insights on what you should consider before moving into a tokenized structure. We continue to add value, meaning like we are here to act as like a bridge between the traditional space and the blockchain economy. We I think between us we can act as like an infrastructure layer, and I'm hoping like Colin can share more details about that. But we provide like a base for efficient and secure issuance of tokens, trading of the tokens, and the full life cycle, including redemption, distribution. We can support all of that. We are at that stage now. But more and more will come. There will be like new experiments as well. So I think it's here to stay, and potentially like faster growth now.
First, I think at an asset level, I think we'll see tokenized treasuries directly in a lot of ways. The second thing I think we'll see is, which I know aren't funds, David, but I think that's an important step to see treasuries tokenized directly on chain. The other thing I think that'll be pretty compelling is you've seen Thomas alluded to this earlier, right? But you think about like the underlying within these funds. I think you're going to start to see, and some folks are like tokenizing indexes, right? I think you're going to see a lot of that, to be quite honest, which is going to see not only the index itself, but kind of parsing out or picking apart the index itself on chain, and kind of trying to understand the assets at the asset level, and how those could perform, or how you could kind of rebuild an index fund natively on chain. I think we're going to start moving away from digital twins and start to see the instruments, the assets themselves, and the blockchain itself serve as kind of like the transfer agency or kind of like the ledger there, which I think will be really interesting. And then a thing that I've always kind of thought about is I think people think about tokenization as kind of a commodity, but I've always just thought, given the breadth and kind of the scope of all the different financial instruments that exist in the traditional world, I just think there's going to continue to be specialization in the tokenization platform space, right? And how different tokenization platforms will be geared towards or specifically work for different financial instruments, and particularly or potentially in different jurisdictions, depending on regulators' needs. I think we're just going to see continued specialization, I guess, and more detailed asset level tokenization to rebuild or kind of rethink the structures and the performance of some of these funds that sit off chain today. And that's really compelling, I think, for all parties on this call.
Actually, Colin, staying with you just for a brief moment, Thomas had mentioned a potential barrier right now is like being education. Something that you'd mentioned that stuck with me is digital twins, right? Do you mind just kind of expanding on that a little bit, like what that is? Because when I'm thinking about a tokenized fund, I just think it exists on the blockchain, but maybe a little bit more color what a digital twin is, and are there any barriers that need to help with that?
Yeah. So right now, I think there is a large amount of work that's being done between the reconciliation between on-chain transactions around some of the funds or tokenized assets that exist today on the blockchain that are really wrappers and representations of off-chain instruments, right? And so you have these effectively you're making the operational complexity and the reporting complexity. And I think someone like Audio can probably wax poetic on this, but you're really in a world where you're having to run kind of the reconciliation and end-of-day books and counting and records for both the on-chain of activity of the digital twin. And second, the kind of the representation of the asset off-chain where it's issued off-chain. What I think we'll get to over time is where you actually just have kind of the system of record and proof of asset, if you will, with the actual tokenized asset itself, and that is actually the investment itself, the asset itself, the fund share itself, and I think that's really exciting. I think that's going to take a lot of regulatory um, um, clarity and kind of work to get there. But I just see I see that as the direction of travel. What I think why the reason that's so important is I think you can, and the big philosophical leap is we have to start to begin to maybe not trust but verify that the blockchain can act as kind of a system of record and an accounting record, like a true ledger for us against the asset and how it performs in an on-chain ecosystem. We at Chainlink are really interested in where that's going to go and where Chainlink plays and kind of how our oracles can support that world. But I think that when you really get to that level of when you kind of eliminate the digital twin and you can start to rely on the asset itself as the asset for what it is in a tokenized format and it's recognized by regulators, then you're going to unlock a whole nother level of efficiency and from the operational perspective of how these things are managed. And so that's what I'm talking about when I speak about digital twins, David.
Yeah, no,
And
thanks. That's helpful.
Audrey,
Sorry,
you
I didn't
probably have
if
want.
some
I,
thoughts. Go ahead.
yeah, I do have a few thoughts I want to add. Actually, I saw and I've read and I've seen like three different ways tokenization has come into life so far. One is distribution or distribution fund or like a feeder kind of structure which sits outside of the fund, and then that fund is tokenized and acts as a distributor of the fund tokens. So meaning like XYZ fund, and then you have a new fund outside of XYZ, but only invest into XYZ, and then that new fund is tokenized. Then there is a digital twin model where you tokenize the fund and then you maintain offline register, off-chain register, just from a business continuity perspective, or making sure if there is a fallback in place. And then there is this like on-chain kind of environment. But to Colin's point, there has to be a lot of trust to reach to that stage. But it does unlock a lot of efficiency, as Colin mentioned, and we are fully, we can support all the three kind of structures that exist out there right now.
So it sounds like we're moving in a direction where funds will be fully operated on chain, which is great to hear because of all the efficiencies it gains. But I'm curious, Thomas, are there any other barriers you think besides just getting everyone up the education curve that's really going to unlock that next wave of institutional adoption?
Yeah, I think it's a classic cold start problem where the network effects of having everyone on chain is huge, right? So, for example, it's great for me to have stable coins, but it's not that helpful unless Colin and Addy also are on chain and we can send money between each other, right? So there is that bit of a cold start of okay, who's going to do the legwork first, and that's really where having large institutions over the past year or so begin to say, hey, this is inevitable. We're doing this and we're investing in this technology. Come and join us, has created that flywheel that is beginning to take off. But I think that is kind of one of the biggest challenges here is most of the time when we talk to a lot of TradFi institutions, they think, okay, well, actually, if we were to tokenize this, how would you place it? Who would be on the other side to buy it? And then, of course, you have to think, okay, well, right now, the investor universe who might actually buy some of these different products need to also be fully on chain. Have the compliance teams and legal teams and custody teams to understand what this new asset class looks like from a tech perspective. And so beyond education, it really is kind of that network effects that we think are increasingly happening, and we're excited to see how quickly it's moving. And one thing that's clear is that switch has kind of flipped. In 2 years ago, it was very much outbound, us making outreach to traditional players. Now it's inbound. They are coming to us and saying, "Hey, we're on board. It's not why, it's how and who we should work with to help us think through not only from a strategic point of view of how we make this transition, but from a practical point of view of who we work with and how we actually do this in practice to reach the goal that we have as an institution." And that conversation is just completely different than it was a year ago.
Great. Thanks, Thomas. I think with that probably tees up, to the panelists here. Are there any sort of, closing thoughts you might have for the audience, or like what is it that you're excited to see come next in the industry, in the tokenization and RWA space in the next 12 to 18 months? Some maybe final thoughts for the audience to take away and really get excited about the ecosystem.
I guess one thing I will just to kick it off. One thing I'm excited by is this first wave of what we call real world asset adoption, where TradFi players will take traditional assets and put them on chain. That's kind of this first wave. I'm excited for the second wave, where once everything is on chain, what new innovations people will come up with to innovate on top of this using this technology that isn't possible. And one quick example would be today, if I want to go between two stocks, I have to sell into cash and then buy that second stock. Well, as when everything is tokenized, those stocks can just you can spin up a dynamic pool based on the demand that's seen in real time on chain and just have them trade in real time with instant settlement. So just a quick example of really what that unlocks. And well, if you can do that with stocks, then why couldn't you have dynamic pools of equities that spin up around specific events over a specific time frame, say, when Fed minutes come out, and then kind of dissipate as the demand dissipates as well. So we're just going to see kind of a whole new toolbox that this technology unlocks, enable us to create new financial products and be able to not only cut costs, but also increase distribution in ways we haven't seen in the past.
Thanks, Thomas. Maybe adding some final takeaways for the audience, or
What I'm most excited about is the new ideas that asset managers are coming up with. The workflows that they have created to tokenize these new structures. Everyone is coming up with new ideas, um, and that creates a lot of interest on our side on how we can support all of those structures. So quite interested to seeing like these new ideas come up, and we are looking to support these in the future.
thanks, Addy. Appreciate it. Colin, any other last thoughts or what's exciting on the around the bend from your perspective?
Yeah, I think we're going to start to see some unlocks of real utility in some of kind of in a couple of places. I think you're going to see real utility being exercised by like payment service providers. I think you're going to see like the proliferation of stable coins that are happening at like in a lot of the Web2 companies. You're going to start to see a ton more capital come on chain. And then I think maybe the third is kind of the rise of, like groups like Robinhood, groups like Stripe entering the space. That for me is just incredible. Even when you think about groups like eToro or Revolut, right? You start to get into some of these worlds. Just the amount of, I think just this might be the year that real world assets and tokenization specifically start to enter like maybe more of like the retail lexicon, I'm hoping, as it starts to just become more widely understood and known, and hopefully a lot more utility applied against these assets so that people see, whether that be institutions or retail alike, seeing greater benefit holding the asset on chain rather than holding the asset off chain. That's where I'd like to see that reach consensus in a lot of ways 12 months from now. So I'm really excited about 2026 for those reasons.
Awesome. Thanks, Colin. And with that, I'd like to thank our panelists, Thomas, Addy, Colin. Thanks for spending some time with us today to teach us all a little bit more about tokenization, RWAs, and most importantly, thank you to the audience for stopping by and engaging in this conversation with us. I'd like to point out that, if there are any other questions or if there's any further clarification on any of the topics that we discussed today, please feel free to reach out to the email address that's provided in the chat box of this webinar. We're also going to be sharing a short survey link, and would just kindly request that everyone spend a few minutes to fill it out and let us know how we all did today. So thank you all for joining. Have a great day, and we look forward to connecting with you all again soon. Take care.